Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Welcome to the Stock Play of the Day. Today's stock is going to be Walmart, symbol WMT. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I am the Senior Options Analyst with Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist with Ally Invest.
All right, Lindsey. Well, the SPX is dangerously approaching a new high. What are we seeing happening in the markets this week?
Yeah, we've been watching that S&P 500 for the last week, but that February 19th all-time high remains a pretty tough level of resistance for this index. We are trying to get above that level that we saw back in February. We like you said, we're getting really dangerously close, but we're having a hard time pushing over. We're getting to the end of earnings season, and we are in the middle of the summer lull, so it might be a little bit difficult. We might see some consolidation from here, but we're going to talk about the retailers today, Brian, and maybe earnings from those guys can help push the S&P 500 over the edge, but I'm not sure about that one. Looking at action, though, today, Brian, home builder sentiment came out from an economic perspective, and it was much better than expected. In fact, it was the best number that we had seen since December of 1998. And so the best number on record for that indicator, which is a really positive one, as we've talked about on this show several times. The housing market has just been on fire, especially since the COVID crisis took impact and people would try to move away from urban areas to more suburban areas. I bring this up because when I think about what's going to move the market moving forward, macro data is really going to be very key, in addition to any news on the stimulus as well as the election. So those are the three things that I really expect to move the markets going forward in the nearer term, at least. And so while the economic calendar this week is a little bit lighter, we do get some interesting data points, housing starts and permits. At the end of the week, we'll get some manufacturing data. And of course, as usual, every week on Thursday, we'll get jobless claims. And that'll be an update on the job status of our country. We finally saw those fall below 1 million last week, which is encouraging, though still remains a very, very high number. And that's why, it's been pretty impressive how the market's been reacting despite what's happening in Congress, Brian. We haven't passed the stimulus bill. I don't know if Congress is aware, but we have seen the stimulus, much of the stimulus that was enacted right upon COVID really hitting hard has expired at the end of July, and we still haven't had a new package come through, as Democrats and Republicans still remain very far apart. Now, Speaker Pelosi has called the House back to talk about the USPS and funding for them, which has been a key issue for the new stimulus package going forward. So the House finally did come back from their recess to discuss that. So maybe we'll hear some news on stimulus this week. Either way, the market's really taking it in stride. So those are some things I'm going to be watching over the course of the week. Now, the one thing that I've noticed over the last couple of weeks, Brian, is value stocks, the Russell 2000, small cap stocks have done really well. We've also seen cyclical stocks do well, and the VIX has come down a little bit. It's been in this 22 range-ish. But the Russell, small caps, really interesting move. It's usually something you see at the beginning of an expansionary period. So what do you make of all of that that's going on in the underlying parts of the market? It's a broadening out of the rally, I guess, that we've seen off the lows.
Yes, and so I have a chart up here of the Russell. It's actually the ETF that follows the Russell, the IWM. And the chart is interesting in that it's had the Russell in general, or small caps in general, a better way to say it, I guess, have had a strong run in August. And that's always a good sign if the small caps can lead the way and have basically outperformed both the NASDAQ and the S&P 500 index since the beginning of August. Now we've had a little bit of consolidation. And if I just look at the chart very quickly, right here, right at about this 160 level, if we go back, we see a couple of touches here. It seems like a little bit of a tough area for the Russell to break through, and we've seen a little bit of a consolidation on it. But in general, when we see the VIX coming off, finally getting below that 25% level, going down towards more quote unquote normal levels, down around the 22% range. And we also see the Russell, the small caps, leading the way. Those are two fairly decent signs for the marketplace. Now, the next big thing is, can the S&P 500 close above a new high? And that obviously would be a nice breakout to the upside. So with that said, though, today we're going to talk about Walmart. And we have the chart of Walmart here. It looks a little bit like something that my toddler would have drawn. But with that said, Walmart is going to be announcing earnings tomorrow. What do we see happening?
Yeah, they are reporting earnings first thing in the morning tomorrow, bright and early. So it's going to be a big deal. They're the first of the big retailers to report this week, Brian. We actually have 17 companies reporting, which is only 5% of the S&P 500. We're most of the way through the second quarter earnings season, which I must say has been a lot better than most people had expected. Of course, the expectations were pretty low because there was really no guidance for us to go off of. But eight retailers are going to be reporting this week. Walmart kicks it off tomorrow morning, but we're going to hear from Target, Lowe's, Home Depot, I think Kohl's as well, some of the other big guys. So it'll be an interesting week for sure. Walmart should be one of the winners during the COVID crisis. But before I get into a little more into my fundamental analysis, I want to remind our viewers that Brian and I do take your questions at the end. So be sure to chat us in the box on the right-hand side of the YouTube screen there, and we'll get to them, as many of your questions, at the end of the show as we can, whether it's about the market, Walmart, the trade that Brian's going to do. We're happy to take them. So please do that. Anyway, Walmart, we're looking at this chart. Yes, Brian, your son definitely could have drawn this for us. But believe it or not, despite the erratic nature, it was funny, Brian and I were talking before the show that if you look at the move in March and April, it's kind of like investors felt a little schizophrenic, unsure is Walmart going to do well during this pandemic, during this shutdown, or are they going to be as negatively impacted as some of these other guys like the restaurants, And I think, you saw a big move up there in April and into May. And that was the realization that Walmart was going to be a winner because they offer a lot of the essential goods that we all need. 50% of their sales, guys, come from groceries. So that's been a huge boon for them. So this stock, by the way, is up 14% year to date. That's versus the S&P 500, which is up 4%, 4.5%. In the last since August started. So only 10 trading days. We've seen the stock move 4.3%. So that's a pretty big move in 10 days and also ahead of earnings. And today you see that gap up. I'm sure Brian will probably talk about it a little more over today that's happening on the right-hand side, up better than 2%, I believe. And that is, seeing a stock move like that, especially a gap up like that right ahead of earnings, makes you a little nervous, but that's why it's easier to trade options ahead of earnings probably than the actual stock. The stock also has been a winner too in this market, I think, because it has a high quality dividend yield, 1.6%. It's a little bit lower than the S&P 500, around 1.92%. But still in this market with yields where they're at, that's a pretty good dividend yield to hang on to in uncertain times. But when I think about the Walmart story, one of the biggest things that they've got coming down the pike from a fundamental perspective and a growth perspective is this Amazon Plus, which they just announced in July. And that was that big spike up you see in July was regarding the announcement of Amazon or Walmart Plus, which is going to compete with Amazon. It's a subscription service, and Wall Street loves subscription services because it's guaranteed revenue on a recurring basis that you can count on, and it's high margin revenue. So what's not to love? So that's why the stock initially jumped on that. Many analysts that cover the stock closely say not only is this going to make Amazon able to compete with or Walmart compete. Sorry about that. We're talking about Walmart. Walmart's going to be able to compete better with Amazon with this service. They'll be able to take share. The hope is they're going to be able to take share in the grocery space. Like I said, they already do big business in grocery, but people are changing the way they shop, especially for groceries during over the course of the last 6 months since the pandemic hit. People are ordering groceries a lot more frequently online, and guess what? They like it. So for Walmart, if they could keep the new customers that they've gotten in the grocery business, transform them into subscriber customers to Walmart Plus, they should do pretty well. Again, that's a high margin revenue for them. So Wall Street's pretty excited about it. The one thing that kind of took a little steam out of the boost was that the announcement to delay the rollout of Walmart Plus. But people are still pretty excited about it. We're also in the back to school season, so I'd be remiss if I didn't mention that. People are a little nervous about the back to school season, given how many schools are going to be virtual or part-time virtual, part-time in person. There's a lot of angst around it, but Walmart should actually still do pretty well because of the virtual nature of schooling going forward. They offer a lot of gadgets and a lot of other types of school tools that will benefit parents and the kids and teachers as well. So the expectation is Walmart to be a winner once again in the back to school season. Thanksgiving, again, another announcement. A lot of retailers are saying that they are not going to be open on Black Friday or into the wee hours the next day. I have fond memories. I used to cover these retailers, Brian, back in the day, and on Black Friday, I would show up at the opening of some of these retailers, and it got earlier and earlier every year. It was like 3 a.m., 4 a.m., 2 a.m. It was not that fun. But you got some great deals when you show up that early, I'll tell you that. But anyway, they're not doing it this year. But again, the move to online, their robust e-commerce offering with the combination with Jet.com and everything else they're doing really should help them do well this Thanksgiving and holiday shopping season. And consumers out there have actually saved a lot of money, and I think they're going to want to spend that money this holiday season because they haven't got to do a lot of the normal things and spending that they typically do, even though unemployment does remain pretty high. So it's going to be interesting to see how tomorrow's numbers come out. Expectations are very high, Brian. The multiple, you know me, I always like to talk about valuations of these stocks because valuations do matter regardless of what people tell you in this market. But Walmart is trading at 26 times on a forward price to earnings basis. That's a pretty rich multiple for Walmart and especially for the retail space. That compares to their 5-year average of 19 times. So about a 37% premium. And now Barron's wrote a story over the weekend too, talking about Walmart and Target because they're both reporting earnings this week. And Target is trading at 22 times. So in that article, they kind of favored Target a little more over Walmart just simply because of that valuation. But Target's 22 times forward PE multiple, Brian, that compares to 15 times 5-year average. Again, so it's also been stretched a bit. That's about a 50% premium versus a 40% premium to the historical average that Walmart's trading at. So I don't know. They're both stretched. Walmart seems to be a little less stretched than Target. They have some good catalysts coming down the pike. We're not doing an analysis of Target here, but that also could be an interesting one going into the earnings. They're going to be likely also be a winner during the back to school and holiday selling season. as consumers still hang on to and look for value. But that's my long spiel about the retailer space going into Walmart's earnings report tomorrow. Brian, the stock has been a little bit erratic, which isn't typically normal for Walmart. What is the options market is always interesting to look at because they'll price in an expected move in the stock on the earnings report. What are you seeing there? And then, before you get into your trade for us.
All right. Yeah. So the expected move by just looking at the long straddle, buying the most at the money call and most at the money put on the nearest expiration, which is going to be this Friday, we see that trading for around $6.30. So that's about 4.5%. So that would be kind of the expected move. That's the line in the sand, if you will. Now, remember, that has no regard to direction. Whenever we're looking at that, we're just saying volatilities are saying that that type of move would be handled well by the marketplace. The marketplace thinks that that move is possible. So with that said, if we look at the chart, we did actually set a new high relative to what happened in April and May, where the market came roaring back. So we did get to a new high, and we actually broke out of that today, as opposed to waiting for earnings. It looks like we've already kind of made that breakout to the upside. So like you said, valuations are a little bit high. We're going to do what's called a FOMO trade, and we've kind of termed that ever since the pandemic has hit, and it's just a fear of missing out. That's what FOMO is standing for. So what we're going to do is say, okay, if we're willing to buy some Walmart, now you got to have that concept in your head, in that if Walmart does go down, I would be willing to buy 100 shares at a lower price than where it's currently trading. That strategy is called a cash secured put. So as long as I have that mentality, I'm saying, okay, well, if they announce earnings, stock comes down, why not buy some more? It's an opportunity to do that. And when you do that, as you'll note here inside the Ally Invest option playbook, we sell a put, we bring in some premium, and it's going to be a good amount of premium. Why? Because they're going to be announcing earnings. So that has a tendency to make the option contracts a little juicy because of this unknown news event. Now, with that said, if we get put to stock, then we see the dotted line. The dotted line here inside the playbook we just did to represent the fact that if we do buy it, now we own stock. We don't own stock up here where it's currently trading. We own it down here, and we get to keep the premium, and we buy the stock at that strike price. Now, here's another FOMO that goes along with the FOMO, right? The fear of missing out to the fear of missing out, and that, yeah, I'll be willing to buy a little bit if it goes down below my put strike. But what if it goes up? What do I do about that? Well, then the other side of the trade would be we're going to look at a long call spread. So we're going to take some of the cash, not all of it, that we receive from selling the put, because remember, we're getting a good amount of cash because of this earnings announcement. And then we're going to turn around and we're going to use it to buy a long call spread, just in case the market actually goes up after earnings. We don't want to miss out on that opportunity. And then just, gosh, I wanted to buy Walmart. Now I got to buy it at a higher price. Okay, so the whole trade together, there's really no name for this strategy. And that's why since the pandemic, we kind of term this around earnings, especially you have a lot of stocks on that are been way beaten up. And we've had a lot of stocks that have been winners. Obviously, the winners and losers have, I think, in this marketplace have happened more than almost any other marketplace, because a lot of stocks have done very well because of the situation that's going on in the world. And a lot of stocks have been just cremated because of it. So going back and forth, if I look at the trade, we're going to look at selling a cash secured put to bring in a net credit, and then using that credit to help buy a long call spread. So let's see how this trade works out. So with that said, it's also okay to just do one side of this trade, right? We're making it fairly fancy. And as always on the stock play of the day, it's not meant to be a recommendation. We're just looking at it as a paper trade, especially when you're doing a fairly advanced trade. This is going to be 3 legs if we enter this trade all as one trade. And we can do that through the Ally Invest option trading platform. But this is all about earnings. This is all about the nearest term expiration, the August 21st expiration. It's 4 days away. Right now, we see Walmart is up 2% today, $2.71. Here's the earnings date. It's before the open, as Lindsey mentioned. Here's the dividend. 135.31. We go down to this expiration with 4 days remaining. I'm going to sell the 132 strike. Now, it does say that the market could move around $6 just by looking at, well, what if I bought this call and I bought this put? Calls are on the left, the puts are on the right. That means that if I bought that, that would be a long straddle, and that gives us a hint as the expected move, the expectations after earnings, either to the upside or the downside. Once again, not a matter of direction. But I'm going to go down about $3, saying that I really do kind of want to buy the stock. I'm not going to go down $6, which is a potential move here. I'm going to say, all right, I'm going to take about half of that. And then I can bring in a little bit more premium because I'm closer to where the strike is at. So in that instance, the 132 put is trading for 160 by 164 or 159 to be more exact. Maybe I could get 161, 162 for it. And now I'm going to pay attention to how much I'm going to receive for selling that put. And I'm going to look at some strikes to the upside. So on the upside, if we buy the 136 strike call, it's a little frothy. Like I said, I'm going to highlight implied volatility. That's a 54% implied volatility, so that is frothy, but it's understood. This is kind of the expectation going into earnings. Implied volatilities are going to increase. And then we're going to go out and sell the 140 strike. So we're going to give us a 4-point wide spread. That means the maximum that this could trade for is 4 points. So with that said, I'm picking these strikes because if I buy the 136 and sell the 140, that's less. That costs less than just selling the 132 put. That means I'm going to bring in a small net credit to my account. All right. So here's the option strategy workbench inside the Ally Invest live trading platform. We are selling the 132 strike put, and at the same time, we're looking to buy the 136 call, sell the 140 call. This is 3 legs. But we're hoping to get this entire trade done for a net credit of 20 cents to the account. So what does that mean? If Walmart goes up after earnings, we'd like it to go above 140. That means that we can make the maximum on our trade, which is 4 points. Plus, we didn't pay for this trade. We have a net credit to the account, and if we fill it to midpoint, it would be 19 cents. We're going to say 20 cents to make the math simple, all right? We're not never guarantee of a midpoint fill, but we're just going to make the math simple here on stock play of the day. So with that said, that means that we could make $4.20 on the upside if it made that expected move 6 points or more to the upside. Now, on the downside, we got to be willing to buy some stock, or you're going to have to do some type of protection. But the concept that I am saying is if I'm willing to buy stock after earnings, after the earnings announcement and the underlying goes down, then I have to have that capital to be able to buy it. But if I'm willing, then I'm saying I will buy that stock at this strike price of 132. That would be $13,200. But I also get the small credit still, no matter what. When I sell something, you get a credit. That means it's in your pocket. You can use it to do whatever you'd like with it. If we got a 20-cent net credit, that means our actual purchase price would be $131.80, right? That would be our price that we'd end up, our cost basis for buying that 100 shares of stock. So let's make this the official paper trade. We're going to put this in the right rail. And I'm going to put this down as a net credit of 20 cents to the account. Market looks like it's moved a little bit, but when we were talking about it, it was a net credit of 20 cents. Yeah, it looks like the market's gone down just a tad. So net credit of 20 cents in the account. And what we're looking to do on, once again, as a paper trade, because we're trying to learn here, we're going to go out and sell the August 21st expiration. It's this Friday, 132 put, hopefully take that credit and go out and buy the August 21st expiration 136 call and sell the August expiration 140 call. We're going to do this for a net credit to the account of 20 cents. We got some upside if after earnings Walmart goes up, but on the downside, we're saying, well, we're willing to buy some stock if the market goes down. Now, just to try to highlight this trade overall and kind of why we're calling it the fear of missing out trade. First of all, there's no name for the strategy. It's not named inside the options playbook, but this is our outlook in that Walmart is trading right here where this white line is at right around 135. We're saying if it just stays between 132 and 135, well, nothing really happens, and I could just buy the stock. If it goes up, though, I want some protection to the upside. And so you see the dotted line at expiration just this Friday saying that if it goes up, well, then I'd be profitable, but I'm only limited profitable. From 140 on up, I can't participate anymore in the upside. So then I'd have to make my choice from that. But that means it's got 4 points worth of upside. And then on the downside, 132 is where my strike is at. I'd be willing to buy stock at that level. That's what my mindset needs to be here. And then if it does, well, then I own stock. Then I have all the headaches and benefits of owning the stock. I have substantial downside and I have unlimited upside if I own stock at that price. But I do actually have to pay for that stock. They don't just give it to me. So I'd have to be able to buy 100 shares at that 132 strike. And it's better that we call it cash secured if you actually have that cash in your account to be able to buy that underlying stock at that price. So this is our fear of missing out trade, kind of coined that since the pandemic. And it's just mainly saying that I would like to buy Walmart, but they're going to be announcing earnings. What's going to happen to it? So I'm going to use my option contracts to try to limit my risk on the downside and also give me some upside potential all at the same time, just in case Walmart announces earnings and the stock just doesn't do as well. All right. Well, Lindsey, I'm assuming we probably have a few questions out there. Let me pass it back to you. Is there anything interesting in the chat box?
Yeah, a little bit of a quieter group today, but we do have a couple questions. First up is about the options playbook, which for those of you who don't know what the options playbook is, you can go to optionsplaybook.com. It's a book Brian wrote about options trading. And he showed you a couple of the pages from it right there. There's the long call spread. So you can also buy it on Amazon.com and other places. But Badger Dono says he has a second edition. Is there going to be a third edition? Do you know, Ryan?
Well, I guess he's asking me to write another book. Is that not? Let's cut to the chase. At this point in time, we don't know. At this point in time, I don't actually know how we would expand the book, but it has been suggested, and we will definitely think about writing a third edition.
All right. Talal Hassan has a great question. If we wanted downside protection, which strike would you use?
If you want a downside protection, in other words, I'm going to go out and sell the put and then buy another put, like maybe take that 30 cents and buy that other put. That's an interesting way to look at it. So now I'm selling a put spread to buy a long call spread. Now we're really getting fancy here. But if I go back to the Ally Invest option chains, I would really look at the 20, now it's 13 cents, but the 20-cent net credit that we were talking about. And because I really don't want to pay a debit for this trade. So I would go down as far as I could and see, well, all right, if I'm going to buy some protection, what can I get for 20 cents? And it looks like the 124 strike is about how far down I would have to go. Because my whole goal here is to try to put this trade on and not pay for it. Now, I'm going to have to pay for it in that I have to have the requirement in the account to be able to buy that underlying stock. But I don't want to pay a net debit for all three legs of the trade if I put that trade on. So yeah, I would look down to the 124 strike, and obviously if you look at the Walmart chart, 124 isn't out of the picture. It's been a crazy chart ever since the downturn in March overall. So I guess that's where I would look at it. I wanted to get, if I'm going to buy an additional option inside the Ally Invest chains, this is trading for 20 by 21. If it stayed, I would just click this little button and I'd add a little B there, and that would add that to my actual workbench down below. And now we would have a 4-legged trade. So now we're getting really fancy here, Lindsey. All right.
Getting a little complicated there. Similar question from Stein 3D says, could you compare this to the FOMO trade with the short put spread on the downside? Is that the same thing, really?
Yes, that is. That basically, so we just basically covered it. And if I did it, once again, my whole goal is just to make sure that I get this done for even means that we would do it for 0, or a small net credit to my account. If you want to pay a debit, that's fine. You get a little bit better protection. It's up to you. But my approach to this is I really don't want to put this on for a net debit to start going into earnings.
Yeah, I think it makes sense. And then final question before we have to go, we're right at time, from Scott Breyer. How do you use IV to select strikes? Do you pay attention to HV?
HV. Okay, so IV would be implied volatility and HV would be historical volatility. And around earnings is really when I would pay the most attention to the IV. That means what the marketplace is implying the underlying stock might do before earnings. And we actually kind of summarize, I didn't flat out say it, but one way that we look at it is you look at the long straddle. So I'm going to put up a long straddle real quick like here. I'm going to remove all of these little check boxes. And the long straddle literally is using the IV because it's trading at a 53% implied volatility to kind of just look at what that expected move is. And because of that, that's how I would use my strikes. We picked the 136 strike and we sold the 140 strike. That gave us 4 points. The expected move is 6 points. So one of the things that I wouldn't want to do is I don't want to go out and sell something 8 points out of the money. Why? Well, the marketplace is saying that would be a real big move. And so why sell so far out of the money? I want to sell something on my long spread. I want to sell something that could possibly happen. So we went 4 points as opposed to the full 6. They're saying, the marketplace is saying, well, that's a feasible move in the underlying. So always looking at the long straddle before earnings gives you a little bit of a hint as to what the implied volatility is actually saying about the option contracts. So now to go into more detail than that there are entire seminars that are based off of historical and implied, but definitely would rather look at implied going into earnings than what the actual historical has been. Implied says that this earnings is going to do something to this underlying stock. And so because of that, the options prices are going to be a little bit more frothy.
Yeah,
all right.
That's a question you get a lot, Brian. It's a good question. Well, that's going to do it for the show today, Brian. But before we go, I want to remind our viewers that you're going to review this trade on Friday on the Stock Play of the Day Overtime show at noon, streaming at the same time as we do on Monday. But it's just going to be Brian covering this trade, and we'll see what happens after earnings tomorrow, Brian.
Yes. So don't forget to click subscribe and ring the bell so you get all the alerts. And we'll talk to you soon.